Should you be taking salary or should you be taking dividend? That is a popular conversation I've had with business owners. And so I have decided to talk about that today. Whether you're just starting out or you're quite established, I am pretty sure at some point this is something that you have thought about. And I am here to hopefully bring some clarity to that conversation. Now, before we get into the details, let's talk about certain factors that you should consider in making your decision. First one are tax implication. What are your corporate tax rates? What are your personal tax rates, right? And we're going to talk about certain things like the small business deduction, what that is, how much that is, and why it may play a big role in making your decisions. Another thing is retirement planning. Are we going to be looking to pension plans, personal or government, or are we going to be looking to the business to provide us with retirement income? Other thing is creditor protection. We're going to talk a bit about creditor protection, talk about disability coverage, both of which are, risk management strategies. We're also going to, briefly talk about passive income limitations. So if you have too much money in your corporations, there are some limitations that may lead to, and also some estate planning opportunities. Now, before we jump into this, let's talk about the small business deduction advantage. What is that? For CCPCs, these are Canadian controlled private corporations. They benefit from reduced tax rates on your first $500,000, right? And again, you have to be an active business here. And I won't spend too much time on what those definitions mean. I think it's a great opportunity to speak to your professional advisor that you're working with. But if you're a CCPC, for your first $500,000, you benefit from the small business deduction. Now, this creates a significant opportunity for tax deferral compared to personal income tax rate. So, for example, if you have $500,000 that you could have kept in a corporation, it's going to be taxed at 12.2%, versus if you took that $500,000 personally, we're looking at over 50%. Now, if you're in Ontario, we're looking at potentially 53.53%, depending on whenever you hear this video, right? But you can see that is quite significant in terms of taxes, right? Now let's talk a bit about what would happen if we retain funds in a corporation before we get to the more personal levels of RSPs and CPPs and things of that nature. If you keep funds in the corporation, as we just mentioned, you're making $500,000, corporate tax rate on active business income on that first $500,000, as an example in Ontario, is 12.2%, right? At a personal level, just mentioned 53.53%. So there's tax consequences. So a lower corporate rate if it stays with a corporation. Next thing you have to consider is retirement planning. Now, if you build corporate assets that can fund your retirement, that could be quite strategic. Why is that? Because what it allows for is, it allows for you to have a lot more control over when those funds are paid, right? So there's a certain time and control, if you will, because you could defer personal taxation until funds are needed and potentially withdrawn at a lower rate. Whereas if funds go to things like an RSP, once you reach, for example, age 71, what will have to happen is a certain amount will have to be converted to a RIF. Well, everything has to be converted to a RIF, and a certain amount has to be taken as income annually. And if you're a CPP, also once you're 71, you start receiving those funds and you can control it. Whereas if it's in a corporation, you determine how much comes to you each year. Another thing you should consider for retaining funds in your corporation is growth potential. More after-tax dollars remain in the corporation, and you could invest those funds in business expansion and investment opportunities. With a lot of business owners, the conversations that I've had in the past, some of them will say to me, quite frankly, Anthony, instead of investing in the S&P, I'd rather invest in the SME. What they mean by that is, for money they put towards marketing dollars, for hiring people, for improving product, etc., they get a higher ROI, right? So they say, yeah, I could get 6, 7, 8%, whatever it is, from the stock market, but when I invest, my return is 25, 30, whatever percentage they may say, right? So here are certain things, So these are the potential tax deferral strategies for retaining funds in your corporation. Lower corporate tax rates, retirement planning, you got to consider that, growth potentials and opportunity, and also you have more flexibility where it comes to timing. By the way, when we talk about retaining funds in your corporation, this really only makes sense if you don't need all the funds. Obviously, if you have personal living expenses, it makes no sense to keep the funds in a corporation. In many instances, it doesn't, where you have personal liability and you're taking credit cards and loans, etc., in order to save some taxes. So most instances, what you're going to look at is you're considering retaining funds in corporation when you have enough money coming to yourself personally, right? Now let's look at some key differences between salaries versus dividends. So look at the different things to consider. Let's look at corporate deductions, RSP contributions, CPP, personal tax treatment, income splitting, administrative burden. Right. So for corporate deductions, when you receive a salary, is a deduction expense for the corporation. When you receive a dividends, it's paid after taxes. So it's after tax corporate profits are used to give to provide you dividends. So obviously expense for the corporation, deductions, lower the tax burden. For RSP contributions, when you receive a salary, that creates RSP contribution room, whereas we have dividends, no RSP contribution room happens there. With CPP, a certain amount of your salary that you receive goes towards CPP contributions, which allows you to have, and for those who don't know, CPP is Canadian Pension Plan, allows you to have a certain amount that will be paid to you by the government in your latter years when you go to retire. If you're taking dividends, no CPP contributions or benefits will be received there. Let's talk about tax treatment. If you receive salaries, personal tax treatment at a graduated rate. If you're receiving dividends, you're eligible for a dividend tax credit. No, if you're receiving quite a bit of money and significant funds, what you're going to find is salary in most instances are going to be higher than dividends, all things being equal, right? And so, of course, is why many business owners tend to just take dividends because of the lower tax, and they say, I'd rather pay lower taxes than deal with investing in my own way without the RSP contribution, and then I don't need to worry about CPP because I could get ROI in a better investment account that's non-registered, right? So some things to consider. Income splitting, you have the opportunities, but there are still some limitations in both instances. From an administrative standpoint, if you're taking salary, a lot of times you're working with a business owner, you're working with a bookkeeper or an accountant, and so there's certain administrative costs and certain administrative burden that comes with that. And if you plan to do it yourself, very few people, quite frankly, I've never seen a business owner do it themselves, because quite frankly, they're more invested in putting time in the business to get ROI. So just know there's administrative burden that comes with additional costs. Whereas if you have dividends, you can simply withdraw the amount, communicate that to your bookkeeper or your accountant, and that's taken care of. So there we have it, certain things to consider from a salary versus dividend, certain key differences. Now, many business owners benefit from a strategic combination of both, depending on your situation. It may mean that you're taking, some salary, some dividends, and quite frankly, depending on how things are from a business standpoint, depending on the fluctuations you have, you may take a certain amount this year, and next year you take a different amount. It fluctuates until you have things at a place where it becomes really static, because you have a certain amount of money coming into your organization above a particular threshold that covers all of these things. So even though I'm giving the differences between salaries and dividends, just know that there could be a combination of both. But I will say, business owners I've worked in the past, that once your organization gets to $500,000, they become pretty adamant about taking salary and bonuses, and I'll explain why. As we mentioned before, once you have an active business income and it exceeds $500,000, you're looking at potentially higher tax rates. In Ontario, for example, you go from 12.2 to 26.5%. So as you can imagine, that's eliminating much of the tax deferral advantage that you had in mind before. And so what happens is once it gets to $500,000, what I've seen with many business owners is that they consider paying out income above the $500,000 for salary, for bonuses, just to reduce the corporate income to stay within that small business deduction threshold. And the advantage, of course, is that you create RSP contribution rooms and you maintain access to lower corporate tax rate because you stay within a $500,000 requirements. Now, if you are issuing bonuses, these are the rules. Bonuses declared in a fiscal year but paid within 180 days after year end are deductible to the corporation in the declaration year. But make note of this, but it's taxable to the individual in the year that it's received. So I just wanted to bring that to your attention so you are aware of that. Now let's talk about a bit of some risk management strategies. If you keep funds in your corporation, just know that you create potential risk of those retained earnings being susceptible or accessible to business creditors and folks who may want to bring lawsuits your way for different reasons. If you're in business long enough, then sometimes these are the things that you will face. Versus if those funds are taken from the corporation and put in things like RSPs or segregated funds or put in life insurance policies, you have the opportunity there to take salary-based withdrawals and convert those funds into creditor-protected vehicles, right? Which can be, bring some stability, bring some peace of mind, right? So that's a risk management thing to consider, right? So this is outside of taxes. That's another thing that you may want to consider. It's also a reason sometimes where people create holding companies, but talk about that for another day. Another thing is, for many individuals, you're an integral part of that business. And if something were to happen to you, like if you have a disability, what would happen is it would affect the income and the revenue of the organization. And for that time being, you would want some revenue coming in, and that usually is in the form of disability coverages. Well, without a salary, here's the thing. Disability protection is going to be minimum because in many instances, the first thing that these insurance companies look to is your salary. It doesn't mean that you don't get any. It just means that you may get lower coverage amounts for income replacement policies, right? And quite frankly, if you're not contributing to CPP because you're not taking a salary, you may not also qualify for CPP disability benefits. So from a risk management standpoint, I know oftentimes people are being driven by just the dollar amount and the taxes, but these are some additional things that you may want to consider. Now, if you're keeping a lot of your funds in your corporation, you also want to consider passive income. So what that means is once your corporation earns more than $50,000 passive income annually, and again, that's annually, access to the small business deduction begins to be reduced. And once you get to $150,000, the small business deduction is completely eliminated, which means you're going to pay substantially higher corporate tax rates, all right? And here's another thing. If you're planning to sell your corporation sometime in the future, then corporations with significant passive assets may risk disqualification from the lifetime capital gains exemption, which is, let's say, rounded up approximately $1 million, depending on when you're seeing this. The big takeaway here is if you have significant amount of passive income, it could affect your small business deduction or the $1 million lifetime capital gains exemption, which you would have had the benefit of when you're selling your corporation. So it's essential to manage your passive income if you have a lot of money in your corporation, and to constantly look at it to maintain valuable tax advantages. And quite frankly, in certain instances, what it may mean is that you extract investment funds or maybe use alternative investment vehicles like a corporate-owned insurance in your corporation, right? Just to deal with these passive income challenges. Now let's talk about the tax deferral options. We mentioned RSPs before. So let's look at the tax deferral options between an RSP and the corporation. For an RSP, you have immediate tax deductions for contributions. You have tax deferred growth until withdrawal. And note that by the year you turn age 71, by December 31st of the year you turn age 71, that RSP has to get contributed to a RIF, registered retirement investment fund, and at that point, a minimum amount has to be taken. So that tax deferral is not forever. You have strong creditor protection, no impact in small business deduction if you're of RSPs, and you have some potential for income splitting at retirement, which I will talk about in a different video, but just know that that's one of the advantages. At a corporate level, you have the tax deferred treatment for certain income types, capital gains, eligible dividends, right? You have more flexibility in timing. We talked about that. You could keep funds in the corporation, and at age 80, you could decide you're going to start to pull funds there, age 72, 73. Whereas if you have RSPs or if you have CPP, then a certain amount will have to be, by age 70, 71, we have funds that will have to come to you, right? There's still potential for income splitting, but no, you could also have income splitting with family shareholders, right? Whereas income splitting at an RSP level is just with your spouse. If you have family shareholders, there are opportunities there, especially if you're a family-owned organization. Good opportunity there. There's also access to corporate-owned life insurance strategies that are unique to corporations that bring tremendous benefit, and especially tax benefit. With a corporation, you also have what's called a capital dividend account, which allow for tax-free distributions. And a capital dividend account is not a real account like investment account, it's just a notional account. But for accounting purposes, because you're a corporation, there are certain tax-free distributions that you can receive. Now, whether you do one or the other, it's gonna mean you're looking at these three things. One, you gotta look at your retirement timeline. When do you need these funds? Also, evaluate the type of funds that you have and the different tax treatments you receive. And also, again, at a corporate level, if you're keeping a whole bunch of money in your corporation, you want to consider the passive income limitations and rules. Now, as I said, there is no one size fits all. So this is what I always tell business owners. Here are some things you need to consider beyond just taxes, which I know a lot of times you're looking at just bottom line. Your cash needs, right? Evaluate your personal living expenses and the cash flow requirements. There may be certain instances where you need everything coming to you, then we're obviously not going to keep money in a corporation. Otherwise, we'd have to look at a balance of both, see what's making more sense. Auto investment strategy, where are you placing these investments? Which one is most strategic? Which one is most tax efficient? Which one makes the most sense at a personal or corporate level? Estate planning, for succession planning strategies or wealth transfers, there may be reasons why you want to keep the money in a corporation, or you may want to pull it out and take it personally. Your retirement goals. Are you someone that wants the security of RSPs and Canada pension plans? If that's the case, you're probably looking at salary. If not, you may be looking at corporate savings and making that a priority. Tax efficiency, that's usually the first conversation, so I think that's a given. The balance between immediate tax savings against long-term tax minimization strategies, and see which one makes the best sense. And also there's some risk management things you should consider from a creditor protection standpoint, disability coverage as we mentioned before. In order to create a customized compensation strategy, again, I think you should sit with your personal advisor to determine which one makes the most sense. But hopefully, having had this conversation with you, this will bring some clarity. Hopefully you find this helpful. If you did, like, share, subscribe. If you know a business owner who could benefit from this, feel free to share that with them as I continue to share all this information that hopefully will benefit Canadian business owners. Take care. Until the next video.